Hey friends, it's Brian, your lovely local lender, and I wanted to come to you with some information on what is actually happening with the loan level price adjustments and a bunch of stuff that I'm sure you've heard that is getting is cheaper for somebody with low credit score to get a mortgage now than it is for somebody with a higher credit score. The reality is that's just not the truth. So first, let's start off with what are loan level price adjustments. So loan level price adjustment is a fee that is added or used to be added or subtracted to a loan based off risk-based pricing that is instituted by Fannie Mae. It has been in effect since the government took Fannie Mae and Freddie Mac into conservatorship after the 2008 real estate bubble, and they have changed periodically from then until now. So you're hearing a lot in the news that on May 1st, interest rates are going to be getting worse for more qualified buyers and better for less qualified buyers. Now, the reality is these changes have been in effect since February for a lot of lenders, since March for almost all lenders, and they have been in effect at least since April for every single lender. And the reason is it's off of delivery date to Fannie Mae. So when that loan eventually gets all the way to Fannie Mae, from the time that it's originated to the time that it's closed to everything that happens after until it finally gets to Fannie Mae for securitization and then selling on a secondary market. So I want to go over a couple of things here. And one is going to be how a mortgage comes to be. And then two, we're going to go over what actually happened with these loan level price adjustments. So first, let's take a look at what happens to a mortgage and what this fee is going to address. So in our homebuyer classes, we go over this slide right here. A mortgage-backed security, how a loan becomes a loan. So a bank is going to loan somebody money for a house. Everybody knows that. And a lot of you may already know this after being in the business, but it might help to be able to explain to clients as well. That bank, we at Movement, we are going to pool this into a bunch of mortgages, and we're going to sell it directly to Fannie Mae and Freddie Mac. A lot of smaller banks are going to sell, or brokers or correspondent lenders are going to sell it to a larger bank to securitize. It takes a whole lot to be able to sell directly to Fannie and Freddie Mac, and the reason that that is an advantage to your clients is that most lenders who sell directly to Fannie or Freddie don't have additional overlays on top of Fannie and Freddie guidance. So, get a loan, gets bundled with a bunch of other mortgages, gets pooled together, gets sold either to a large bank or to Fannie or Freddie, and then that gets packaged into a security and sold to investors on the secondary market. If you've been in any of our classes in the inner circle, you'll see that this is what the secondary market will look like. It trades like a stock or a bond. So now let's go into what these loan level price adjustments are. I want you to take a look at this chart and see what we have here. So Fannie Mae and Freddie Mac are going to have risk-based pricing based off mostly credit score on this side and loan to value or down payment on this side. So you can see here somebody with, say, 740 credit who's going to put 20% down is going to have 1.25%, or excuse me, 0.875%. I got one down one there. Added as a fee to their mortgage rate. So if their mortgage rate was 6% at par, meaning 6% and it didn't cost them anything, they weren't getting a credit and they weren't buying the rate down, then adding this LLPA on would make it 6% with a cost of 0.875 if this was the only LLPA that applied. Now there are others, as you can see down here, for investment properties, manufactured home, 2 to 4 unit properties. These aren't additions that your lender puts on a file. These are additions directly from Fannie or Freddie. So let's take a look at a 640 buyer who's putting that same 20% down. You see here that they're paying 2.25%, whereas a 740 borrower is paying 0.875%. The 720 borrower is paying 1.25%. The 720 borrower, the 780 borrower is paying only 0.375%. So no, lower credit score buyers are not paying less than higher credit score buyers. Fannie Mae is, for all intents and purposes, an insurance company. They're going to ensure that the mortgages that are put in this mortgage-backed security can perform, and they do that with risk-based pricing. And they have always subsidized from higher credit scores to lower credit scores. This is not new. Since the government took them over, this has always been the case. The fact that people are so up in arms and hearing about it now is very surprising to me. So what happened was the spread between these two got a little bit smaller, just a little bit. So you can see here that 660 with 20% down got 0.875% less expensive for a for a purchase. Now, the thing about mortgages that you got to know is just because somebody has a 660 credit score and has 10% to put down doesn't mean Fannie Mae is going to approve them for a mortgage, and that may push them into getting an FHA loan. Something you may not have heard, I sent it out, but maybe you don't remember it, is that the FHA just lowered its mortgage insurance from 0.85% annually to 0.55% annually with a minimum down payment. If you put down more, 5% or higher, you have came down from 0.8% annually to 0.5% annually. So a lot of those lower credit score buyers are already going towards FHA because they're not getting approved for Fannie Mae or Freddie Mac loan to begin with, and then so they're having to go FHA. And then FHA, their interest rate is lower already. The FHA does not have these egregious loan level price adjustments at every iteration of credit score and down payment. And their mortgage insurance has come down. So a 660 borrower or a 640 buyer with 10% down is going to have a large hit to their credit or to their interest rate right here. 640 with 10% down. Right here, you're going to have a 2-point hit. You're also going to have much more mortgage insurance than you would have if you had a 760 credit score and 10% down. So you're probably going to be going FHA anyways. So I just wanted to dispel some of the fear around this and maybe some of the anger. And I get it from people who aren't lenders because this isn't your job. Like, this is stuff that we're supposed to look at every day. This is the stuff that we're supposed to communicate out to let you know what's actually happening so you can talk to your clients about it, because they're hearing this from the news and from the internet. And the news and the internet's job is to keep them glued to their screens and clicking through so that they can sell them ads and make money off them. So if you need anything at all, you know I'm always here. We're not always in the office, but we're always on Zoom, and we're always available by phone if you need anything at all.